Crude oil rallying 10% this month. Geopolitical tensions in the Middle East rising. You got tanker attacks. You've got drone attacks. You've got increased rhetoric with Iran, new sanctions, and export sanctions. That move sending energy stocks higher. It's one of the best performing sectors for June, but been terrible over the last 12 months. With these new sanctions on Iran and an OPEC meeting in Vienna next week, will this crude comeback continue? Michael Bradley is a strategist at Tudor, Pickering, and Holt. He joins us now from Houston. Mike, you and I got to stop meeting like this, talking about oil. I think here's the most amazing thing about oil is that given what we just talked about, given Venezuela's rolling collapse, that we're still only at 57 bucks and change in the United States. Is that simply because of Permian production?
Well, I think it's a combination of two or three things. First of all, it's really demand. Really, demand stats over the last couple weeks and months, as you know, have really rolled lower, and that's just pressing on crude oil prices. From a supply standpoint, U.S. Crude builds have been massive over the last, say, 2 months or so. Typically, over the last 2 months, you get flattish builds. It's been a build of almost 40 million barrels, and so those are huge counter-seasonal builds. So that's kind of weighed on it. And then just recently, let's say about a week and a half ago, the IEA came out with their monthly oil report, and it showed second half of demand going lower and 2020 demand going lower as well, with supply going higher. So it's just a lot of those confluence of events have just weighed on crude oil at this point in time.
Yeah, because I can remember a day, Michael, not that long ago, when if we had tankers being blown up, we had conflict with Iran, the talk about U.S. military ships escorting supertankers through the Strait of Hormuz, you could have seen a 10 or 15% pop in a day in oil. Now you got 12.5 million barrels a day in the Permian that is effectively risk-free. I mean, risk-free from a geopolitical perspective. Have the days of extreme volatility maybe come to an end?
You're going to still have extreme volatility, but we're just we're at one right now, one extreme, and you're right. U.S. production is such that volatility is going to be lower over time. I think the issue with U.S. production is, most people are dialing a million barrels a day in U.S. production into infinity, and that's just not going to be the case. We see at Tudor Pickering over the next couple of years that production from the U.S. shales and U.S. production in general is going to be slowing down from that million barrel a day rate down to probably something in the 600,000 to 800,000 barrels a day. And so that's a good thing. The issue right now is just demand just looks so bad that people don't even want to look at anything else. And so from that standpoint, the volatility's been all to the downside.
So appreciate all the points. How much is the demand slowdown priced in at this point in your view? And secondly, one thing we haven't talked about yet are just summer seasonals. We got hurricane season coming up or started already. We have driving season. Does that matter anymore? How big an influence is that?
No, I think the three biggest events that are going to matter right now is, at the end of this week, the G20, what happens there? If we have a positive event there, that's going to take put a little bit of a premium back into the market. The second is obviously the OPEC meeting coming up on July 1st. I think consensus is that there's going to be a rollover of cuts, roughly 1.2 million barrels a day, and so to us that's the main thing that's going to be an issue out there. And now I think near term, we're a little bit more positive on crude oil, more so than consensus, simply because we do see U.S. crude inventories beginning to decline over the next couple months. Yeah. And so that's going to be a positive catalyst. And secondarily, everyone's looking at demand being lower. We're looking at the Fed, both domestically as well as globally. They're going to be lowering rates and probably pretty dramatically. And so that's going to be a stimulus. And so no one's really taking that into account. Everyone's looking at the bad demand numbers. And if these guys are successful, then you're going to see 2020 demand improve in 2020.
Yeah, and when the Fed cut rates at 95, Mike, oil prices effectively doubled. So there's a Fed aspect. Very quickly, is the biggest risk to oil not OPEC, not Iran, not that it is debt levels in the Permian? Is that a major risk? Because if oil remains in the mid to low 50s, you're going to start to see some of these weaker companies go bankrupt.
Yeah, you've already saw, Weatherford went bankrupt earlier this year. And, the one good thing about the equity market right now, the energy equities, is that, debt levels are not as bad as they were several years ago. A lot of E&Ps have gotten the debt levels back into, pretty good shape. And so, they can live with oil, lower oil prices. I think the area you have to, worry about is, more of the oil service companies. One of the things we've been talking about for a long time at Tudor Pickering is just return of capital, free cash flow. As you know, these E&P companies have been in a spend, growth at all costs type mode. and they're going to be going into a free cash flow, return of capital type mode. And the first return of that capital is just going to be debt pay down. The second thing is going to be paying dividends. So that's just a net negative for oil service companies over time. So I think those companies, the deep water drillers, those are where the leverage is higher. Those are the most exposed. So I don't expect the E&P stocks that's going to be a big issue, except for the guys that are a little bit smaller cap and a little bit more highly levered.
Michael Bradley at TPH, always great insight, Mike. Thank you very much. We appreciate that. Guys, if you know, on my screens here, I've got all the oil stocks broken down by region, Permian, Bakken, whatever it is. They're down 50, 40, 60% in the last 12 months, Rebecca. It has been an decimation of investor capital in energy.
Mm-hmm. Well, I mean, you've got global trade slowing down, global manufacturing slowing down. If you have less production and you have less global trade, what do you need less of? Energy, oil, to move the stuff, to make the stuff. So that doesn't shock me, frankly. And I worry about one thing he talked about that I thought was really important is the debt levels on some of these companies, not all of them, but some of them, and playing that into the high yield space.
So Mike talked about it, certainly for the Permian and really all the U.S. shale and alternative plays, it's all about return of capital, not return on capital. These companies are being run differently. Ultimately, that's a great thing for investors. Right now, it's clearly a prove-to-me story. OIH, in terms of oil services, has underperformed the S&P by 50% in the last 12 months.
Yep.
I still think this is, all we've done is talk about supply. I still think this is a demand story, and I still think the dollar, which has been weaker, is actually not your friend, because if anything, I think the dollar catches a bid in a safe haven. All the charts, by the way, in oil, the 50, the 200, and the 100-day moving averages are pointing down for the first time in 9 months. Not good.
So Exxon and Chevron both trade probably at trough valuations relative to where they should be, 13.5 times. But you look at ConocoPhillips, which I think over the fall the market was concerned maybe they're going to make an acquisition they shouldn't make. I think some of those fears have been assuaged. $59 was the level we traded down to in December. Seemingly have held that now. Trades cheaper than both Chevron and Exxon. So for a trade against 59 bucks, I think COP is really interesting right now.
I think when it held support near 51 was the key for WTI, though. We saw that. Everybody talked about it, and it did, Brian. And it made this massive move to the upside in a very short period of time. I think right now you got to take your chips back off the table and wait and see, do we test that $51 level again? But if you still want to be in something, a stock I pitched a while back was KMI. I love this name. I continue to love this name. And by the way, who keeps buying his own stock back? Richard Kinder.
That's the richest man in Texas, I think, or one of. And by the way, that's not even an oil and gas company. I mean,
no, it's pipelines, but it's somewhere involved in this space.
It's a toll taker is what it is. You know, and
ching.
Listen, just not forget, just OPEC, quick tease. The OPEC meeting is next Monday and Tuesday. We'll see if they keep that 1.2 million barrel a day production cut deal. It's going to be very contentious. You got Iran there. There's a lot going on there. Venezuela. And we're going to be there as well. So we'll be there covering it live.
Come on.
Nice.
Giddy up.
You there?
I will be there.
Big dog.
I will be there in the stairwell.